Welcome to the Invested Teacher Podcast with Kyle Pearce and John Orr.
Get ready to be taught as we share our successes and failures encountered during our real-life lessons, learning how to build generational wealth from the ground up.
Welcome, invested students, to another episode of the Invested Teacher Podcast. Now, my friends, we are excited to dive in. You may have noticed something in the intro. You heard only two names on the way in. Matt is just so bogged down, which is a good thing. It's definitely a good thing. But he has graciously decided to sort of opt out on the regular. But I have a funny feeling we're going to be bringing him in for some check-in updates. Maybe we'll even call them interviews whenever he's available to hop in on the podcast. And also, for those who are listening, we're actually in the middle of a bit of a rebrand right now. Like, we are putting our thinking out there. Yes, absolutely. We are looking at trying to become more specific for the type of people that you are. You friends who are listening are looking to go from whatever your income is, be it a high or mid-income level, to creating high net worth. And over this next little while, we're going to be, sort of shifting away from the invested teacher branding. So just giving you a heads up for that. If you have ideas, let us know on social media. You can tag us right now at Invested Teacher anywhere, but also leave us a rating and review on your favorite podcast platform. And maybe that review could be what you think we should be calling this podcast. That would be a fantastic way to give us some feedback. But before we go any deeper here, John, what is it today that we're going to be diving into with our listeners?
Well, I think this is a common, we often want to talk about common issues, common decisions that we have to make in our financial lives, in planning for financial futures, but also, managing our current portfolios. And I think this is something, and I read the book from Ramit Sethi, I Will Teach You to Be Rich. He often talks about in that book that, you should get all of your money out of the mutual funds. And that was a shocker for me, because I think, on this podcast, I'm on record of saying, like, my dad, was all about, getting his pension. But I mean, like, when we picked, our ESP, so education funds for my kids, our RSPs for my wife, it was like we went the mutual fund route. That was the way to go. Get it in a mutual fund. You don't really have to do any thinking. We picked like a balanced portfolio fund, as a fund. And it was like, let it grow. It's about time in the market, get it in there. And when I read I Will Teach You to Be Rich, the thinking was like, you shouldn't be there because you're paying fees to that manager. And if you put it in, say, an index fund is a low cost index fund. Those are, that particular index fund or index funds will beat mutual funds every single time. So why are you putting that, your money in a mutual fund? You need to get it out of there and get it into index funds. So I remember thinking that all those years ago when I read that book and going, yeah, he's right. Like, I need to get it out of there and get him into the index funds. So in this episode, we want to kind of like talk about, like, should we have done that all those years ago? Is the index fund the right move for, putting some of our portfolio money in those, or should we stick with mutual funds, or is there a balance between them? And that's what we want to kind of talk about today. Maybe do a little bit of debunking of myths, and talking about like that kind of mindset to go, is index funds the way to go?
Yeah. And it's interesting because I think on the podcast as well, we've sort of, done our fair bit of ribbing on mutual funds.
Yep, I think we have.
Right? It's a general sort of thought, and a lot of investment sort of advisors, wealth advisors are, sort of in the same camp. At least those who don't sell mutual funds, we'll put it that way, right? Those who do sell mutual funds and make a commission off of it, of course, they're, obviously not going to be saying a whole lot about it. But let's really like zoom out a little bit, because in previous episodes, we've talked about things about like defining your personal beliefs, right? Like looking to what is it that you're hoping to achieve. We've talked about, what kind of investor are you really? And we've also talked about, even how a lot of people tend to have their financial plan or their investment plan sort of backwards. And sometimes people get like really excited about a thing and then they sort of go all in on that thing. And for some of these people, they might not be ready to do that type of work, right? So really, I think what this comes down to is it's really getting to know yourself and trying to figure out what is best for you. One thing I'm going to give it, to in mutual funds is if you are the type of person listening to this podcast, you're probably not that person that's sort of looking to just sit back and just let it happen. But for those who aren't listening to this podcast, I'm going to say that a mutual fund might make sense for them because it's super easy to do. And I would say if you're going to do something and you can get that barrier to entry down, so if it means calling your bank person or just doing a quick pop into the bank and saying, hey, listen, I want to start putting in $500 a month into this or into that or whatever, that is way better than doing nothing at all. And I'm going to tell you this much. When you're dealing with index funds, the reality is that it's likely that it's going to be more work on you to actually figure out which index fund do you want and how do you actually go about purchasing it. Right. So that's like one barrier right there. Like, and I know for some people, they're going to, come on, you just open up an investment account. Like, it's not that hard to do. It almost seems as easy as getting like, an email address, like a free Gmail address, right? Like, that's how simple it seems. But for some people, that might be enough to hold them back from actually investing. So there is that part that I think we should recognize, is that everyone is different. And nothing is sort of like, I don't think we should be blanketing anyone to do a certain thing or not to do a certain thing, because it actually might have that thing that they need in order to take action. So I want to start the conversation there. But I also want to dig deeper into where this claim comes from about mutual funds. You sort of generically said it, John, that like mutual funds will always lose to the index. And that's maybe a little bit too blanket. Like it's not that it will always, but they do say that mutual funds will not consistently beat the market. So what they're saying by that typically, and if you research this and you look this up, and we'll put a couple articles in the show notes here that you can go off and read a little more about this. Typically, when you look at this massive basket of mutual funds, typically they don't consistently beat the market. And for in some research, they even say like, just to do two in a row where like the mutual fund, the managed mutual fund actually beats the market 2 years in a row is like very, very low odds. Like we're talking like 1, 2, 3% or something of the mutual funds to do that consistently. So over the long term, obviously that's not happening. However, two things that I want to dig into is that what market or what index are we talking about, right? So when they say that mutual funds in general don't beat the index, are we talking about all the mutual funds that exist out there compared to all of their indexes or indices, as we would say? Because keep in mind, there's the S&P 500, there's an index for all 500 of those stocks. Are we just talking about S&P 500? Are we talking about the TSX in Canada? Are we talking about an emerging markets, mutual fund and, comparing that to a index, right? So every mutual fund has an index that it's benchmarked against is what they call it. So there's like a benchmark there. And if you look them up online, they actually on many sites, one that we're going to share today is morningstar.ca. This is a Canadian site. However, I'm sure there's all kinds of different ones in different parts of the world if you're listening somewhere else. But for our Canadian friends, morningstar.ca actually will break down. It'll let you look up all of the different mutual funds that are out there. And then in the table, you can actually see the returns of that particular mutual fund after the fees have been removed. So this isn't like you have to like subtract anything or do any math. It's like, here's what the return was. And it also shows you, here's what the return of the benchmark index that this fund is sort of like trying to beat over time. So you can quickly look at this stuff and you can kind of figure it out for yourself. And what I find is that when it's an S&P sort of mutual fund, that one's a hard one to beat, because basically what you're trying to do is you're trying to like just knock out any of the losers in the 500, businesses. but like 500 businesses, those are like the 500 largest businesses in the United States, in the US stock market, in the S&P 500, that is. So if you're trying to knock off the losers, like that to me feels harder than, let's say, looking at a bigger index, like say an emerging global, markets sort of fund, right? Where like you can maybe identify pretty quickly which businesses have a good model and which ones don't. So it'll be really interesting here for us to dig in. But one thing that I do want people to consider is that just because a mutual fund doesn't consistently beat the index, does it always mean that the index is the better option for you? And is it always the case, right? And I think we're going to dig into that conversation a little bit more here today.
Well, that's what I was wondering. If you said, if I look at, I take the time and look at mutual funds instead of just, doing the easy case. Now, the easy case can be for me because I don't want to think about it, or I just want my money to be, to grow, but I don't want to actually have to like take all the time necessary to like dig in and figure all these things out. I've got other things I want to do with my time. And so that's a case for why you might just go, hey, let someone else manage this. I am going to make money on this. But I don't have to say, get that extra 2%. Like that's, to me, that's the case for a mutual fund. But then when you say there's only 2 years, if it beats the market in 2 years, and then that's rare. And I could have just put that same money in an index fund by opening, say, an online trading, account and buying, shares of that index fund. And that money can grow at that point. It's kind of like, well, why would I want to go with the mutual fund if I know that I can get the better return here versus here? And I guess the only my insight right now, Kyle, is that the only benefit I'm seeing right now is that time aspect. That go, look, we read the book Who Not How for many different reasons, and I've actually read it twice. And it's all about, from Dan Sullivan and Ben Hardy. And that book talks about when you're running, it was more of a business book. When you're running your own business, you want to ask the question, like, who should do this task and not how to do this task? Because oftentimes, a task will come up in business and you'll go like, how do I get that done? Or, what's the process to complete that? Or how do I bring that into my business? Or how do I tackle, that social media aspect of my business? And in the premise of the whole book is about like, stop asking how to get a task done or how to do this. Ask who should get that done, because that will free you up as, say, the business owner on, spending time on building out your business and building on your business versus building, working in your business. And so it's like, get someone else to kind of figure that part out or take responsibility for that component of your business. So that's what comes to mind right now. If you're like Kyle, or you were Kyle, you said like, John, you should, do options trading. Cause we did that for a while, it was like, you should do options trading because it's a no brainer. There's a safe way to do this, but then it's like, but that does take time out of my day. And if I'm going, okay, so does that mean I go down this route? Now I have to schedule a block of time in my day to complete those transactions, or maybe it's a block every week, or it's a block every month. But right now that triggers in my brain, is that a me task or is that a who task? Right. Do I get someone else to do that because I don't necessarily need to do that? And where should my time be spent otherwise? A lot of these kind of choices that we have in life, I now run through that filter of going like, can I get someone else to do this? And if I can't, should I do this? And now, because it is my time best spent doing that activity, it might be, it might be to go down that route and learn about that or take control of that. And it might be just because I want to, right? It's just because I'm excited to go down that new pathway. So, or is it like, should I just pass it off because I'm not really excited to go down that pathway at this time? I can pass it off. I can get someone else to manage that piece. So when we talk index funds versus, mutual funds right now, You know, the lean towards a mutual fund is great because it's like I can pass it off.
Yeah.
And I know that that task is going to be taken care of, and I can go over here and build my business, you know, and I don't have to think about how to manage my money over here. I got someone who's managing that mutual fund. So right now, Kyle, the trade-off for me, right, is like, is that extra fee that you're paying the mutual fund worth it to you versus the extra fee, you know, the extra money you're going to make on the index fund? So like, that's the trade-off right now. Is that, like, let's say it's an extra 2% you would have made each year. Is that worth it?
Yeah.
Dollar amount for you to not do that work.
Right. And I would say as well, like, so great points here. And I think this is so important, so true for so many people, because even when you're doing this, like, what sort of joy does it bring you? Does it bring you any joy? Are you driven to do this work? And like you said, it's like, for a lot of people that don't have, you know, they're not willing to even look into like what an index fund is. Like, for some people, they're like, I don't know what the definition of an index fund is. So for that person, it's like, there is now a barrier to entry for them to even make this comparison. So maybe just go to your bank in the meantime. You know what I mean? Like, just like, hey, go do that. Or someone you trust, like a trusted wealth planner or wealth advisor, doing that. Whatever it is that you need to do, the key is doing the work. And then if you're willing to do that work by getting some money in there, then if you want to go down the rabbit hole and you think that you want to make some changes, then definitely go for it. You know, like, for example, if you read the book that you had cited by Ramit Sethi, is if you read that book, then you've already done a lot of work, right? Like, you've already done a lot more work than a lot of people have done. So following that advice to go index funds and set it and forget it, probably not a bad move. Like, you're not going to go wrong, because the index is the index. However, for some people that are looking for those boosts, it could make sense. So like, you know, we're not here to try to tell you one way, one thing or the other. And I think that's the part that people want. They just want you to tell them what to do. But I guess what we're saying is that, like, do what you think makes sense. So what I want to share with you, friends, is actually an article. This is on Morningstar, and they actually highlighted Canada's top 3 mutual funds of the decade. So we're talking like the last 10 years in Canada, which ones were the best actively managed funds. So I was like, let's take a look and like, let's see what these are. Now, they are not just straight up like S&P or like US broad market sort of, you know, funds. One that came in first was Manulife's Global Small Cap Fund. Now, right off the top, when you think about small cap, we're talking about smaller companies, which means more volatility. So if we're talking about this fund, you shouldn't be comparing it to, like, say, a balanced or a conservative mutual fund that, say, your local bank is providing you, right? Like, you have to compare apples to apples. So when we look at this particular fund, over 10 years, they had a annualized 10-year return of 16.16%. Now, a lot of people are like, that's pretty good. But once again, like, what did the index do? So if I go and I look at this fund up here on Morningstar and I look this thing up, I've got it shared on the screen for those who are watching on YouTube. For those who are listening, you can check it out later. This particular fund has an MER. This is your management fee of 1.23%. All right. So 1.23% is taken off the top and goes to manage the fund. It goes to pay for those expenses, but your returns are net of that number. So it's like, it kind of, to me, when I look at returns, I'm like, I don't care. You could be taking 20% off the top. Like, that's what hedge funds do, right? Hedge funds take a big chunk off the top and you still supposedly get a good return on the other end. So I don't actually care about the MER as much as I do about the actual performance. So if I look at this and I look at just the table over, I think I got to change my view here to get there. There we are. If I look at this table, you can see that the fund returned, like back in 2013, 40% compared to the index of 35%. Then it's 12% to 13%. Ooh, so it lost that year. Right there, it just broke the trend, right? Like, it proved the fact that, like, it doesn't consistently win. But look at the next year, 32% to 18%. That's a big win, right? Like, that's a big win. Even though we didn't do it consistently, this fund crushed the index that year. The next year, it lost, it almost broke even, but 0.1% it lost. The index got 7%. You're like, ooh, that's a big spread. So again, no consistency there. Then it got 22% compared to 15, so it won. Then it's lost 2, the index lost 4, so it won again, two in a row. 25% to 19%, it won again. 15 to 13, won again. 5 to 15, it lost, broke the streak. -17 to -11, lost again, 2 in a row. And then we can look at year to date this year, it's beating the index. So for this particular fund, looks pretty good. And depending on where you start this journey, right, it might paint a different picture. But something I want to share is like, if you did start by chance to invest in 2013, like this 10-year run is looking, you can see on this chart here that this particular mutual fund is crushing the index well, I shouldn't say crushing. It was crushing the index for the most of the time, likely because of that first year bump that it had. It had that 40% bump compared to 35%. And then it had enough up years where it stayed ahead, and then still ahead in 2023. But if you change the time horizon, if you start on, like, let's say a down year where it's losing, what's that going to look like? That's going to change things. So I could change this and I can put it to, so now that we've got this interactive chart up here, you can actually see like this curve's going to look differently if you start at 10 years versus if you start at 5 years, right? You see some down years there, and 3 years, it's like, ooh, it doesn't look that great. But ultimately, at the end of the day, if you are considering a mutual fund, and if you do want to do this comparison, you might be able to find funds, mutual funds, actively managed mutual funds that give you enough upside on the win years that even if it doesn't consistently win, it might still make sense. So the reason I'm sharing this is not to create confusion. If you want simplicity, the easy answer is just put it into the index, and then you don't have to worry about someone picking right or picking wrong. It's just the index does what it does. But if you don't have that ambition, you're not even concerned about it, just putting it into a mutual fund doesn't make you a bad person is really, I think, the big takeaway that I want to share. And this is true with many other mutual funds as well. So if you are in a mutual fund right now, what I would recommend you do, this is like a next step for you. If you're curious, maybe you're in a really crappy mutual fund and you should get out of it. If that's the case, do it, right? But make sure you know what you're doing. Like, imagine if you were in one of these funds that actually is doing really well, and then you blindly follow the advice to get everything out and put it in the index when you're actually winning more years than you're losing. And those winning years are significant enough that it actually makes a massive difference in the end return that you get at the end of 5, 10, 15, who knows how many years. Then you're just kind of blindly following, and you're actually hurting yourself more than you're helping. I think in general, you're probably going to find that the mutual funds you're in probably isn't one of the better ones, right? Like in general, you're probably going to find that. But I guess the point is, the big takeaway that I'm hoping people will get from this message today is that don't just write off mutual funds without actually looking into whether you're in a good one, in a okay one, or in a nothing, or in a really, really bad one, right? Like, even if you're in one that's just like kind of hovering along with the index, I don't know, maybe it's not worth your time to actually do the withdrawal and pull it out. And who knows, maybe tax consequences, right? So be smart about it. Don't just blindly follow advice. Take that advice and then think about it and go, does that actually apply to me? Or what do they really mean when they say that no mutual fund, there is not one out there that consistently beats the market? Like right there, you're like, oh, then I'm going to go for the index. But it's like, but what if every other year it does, and it does by more than double? Like, I think I like that a lot, like, so you really just want to look into this, make sure that whatever decision you're making, it makes sense for you. And I want to go back to what you said, John, is that every decision we make, it has to be based on your own situation. So if you want set and forget, maybe you're already in a set and forget, and maybe that's fine. If you're like us, like we're kind of like more fact finders and we're like more interested. But I'll be honest, I've spent thousands of hours diving down all of these different rabbit holes because I love learning about it. But I'll be honest, more and more I come back to, how can I do this consistently without having any sort of like risk? Any sort of risk is maybe extreme, but I want to just know what's going to happen more predictably into the future, instead of me just sort of, trying to find the home run thing that's going to take us to this next place, when in reality, so many of those home run balls end up getting caught at the wall. You just want to make sure that whatever it is that you're doing, it matches your goals, your personality, your financial profile and investor profile. And of course, we on the team would love to be a part of that journey for you. So, hey, if you need somebody to chat with, maybe you're not sure what you should be doing or what you should be considering, reach out to us over at investedteacher.com/discovery. Over time, you might see that link may change, but we'll make sure to redirect if it does. So head over to investedteacher.com/discovery and hop on a call with us, and let's chat it out. Let's see where you're at and whether you've got the right pieces in place. Maybe it's just, the advice might be just continue doing what you're doing. You've got a great thing going, and maybe you might want to adjust something. Who knows? But get on that phone call and feel confident about the work that you're doing to invest for your financial future.
Hey, we want to thank you for listening to this episode of the Invested Teacher podcast. Don't forget, it would mean the world to us if you hit that subscribe button if you haven't already, but also leave us that review and rating. So hit that review and rating button. Go ahead and take a minute here and type in an honest rating and review of the podcast. It does help grow the podcast so that we can help reach our goals, which is helping as many people understand their financial wealth and their wealth creation pathway. So head on over to the review button, hit that, and we look forward to reading it.
Friends, all show notes, resources, transcripts, and the opportunity to book a call is over on the investedteacher.com website. Once again, that is investedteacher.com. And today we're dealing with episode 52. So investedteacher.com/episode 52.
All right, invested students, class dismissed. Just as a reminder, the content you heard here today is for informational purposes only. You should not construe any such information or other materials, legal, tax, investment, financial, or other advice.
John Orr is a mortgage agent with the BRX Mortgage Group, license number M23006803. Kyle Pearce is a licensed life and accident and sickness insurance agent with the PanCorp team and does wealth planning with corporate advisors and the Pan Financial Work Group.